Paul, slightly below the estimates, I say the street, the City of London, let's say. Why the disappointment? I sense that you're not actually disappointed.
Not really. We've grown by 8%. The market was expecting 8 to 9%, so I think we're in line with that. And again, we had previous conversations, 17 countries by more than 10%. The fascinating part is acceleration of growth across the whole of Europe. So all of our European markets, you know, all-time records in France, Spain, Germany. UK, a little bit lower growth than we had in the previous quarter, and continuation of solid recovery in Australia. So from my standpoint, good fees and good profitability.
You don't look at the share price and see that as a score on whether you had a good quarter or not, quite clearly. The question I would have for you, though, is some of the guidance. A lid was on the guidance, particularly because of FX reasons, and we're going to talk about the Bank of England in just a moment. Have those pressures eased somewhat over the last few months? Yeah,
there hasn't been much movement for us in the last couple of months on foreign exchange, and as you know, I'm not bothered about it. We simply disclose the impact on our business. We're focused on how are the markets, what are the opportunities to grow our business, where do we add headcount, which country, which city, which specialism. We continue to do that pretty well.
The UK, Richard Jones. Service sector data, and I'm going to get your read on what's going on in the service sector, but the service sector data, the weakest in some 2 years. We're starting to wonder whether the economy is rolling over in maybe arguably the same way the US is. What's going on?
You see, I think the interesting thing about that, Jonathan, is that the services sector has been seen as the engine of the UK economy. And this is the second straight disappointing services PMI that we've had. It dragged the composite down as well to 2.5-year lows. So it does raise the question, is the engine of the UK economy actually slowing down? And what does that mean in terms of Bank of England liftoff?
Governor Carney's got to discuss that on Threadneedle Street with his other policymakers. Paul, are you seeing a slowdown in the service sector?
Our growth was 6% in this quarter, and it was 8% in the previous quarter. So I think what we've seen in our business is consistent with what we've seen in a number of the PMI data, quite a bit of the consumer and confidence data. So I see this as a little bit more that a few more businesses have focused a bit more on cost control in the last few months. They're still replacing key levers, but for us, we had a good July and August. September was a little bit weaker than we would have expected, but that's more that a year ago we had very strong growth going across September. This time we've had modest growth. Do I think that this feels like there's any sort of risk of slowdown? No, I don't. I just think that we've had 2 very strong years' worth of growth. And at the moment, with everything else going on in the world, a few more businesses, including the public sector, are just sitting on their hands a little bit more. So if you take a look at any of these surveys, there's a bit more focus on cost control, and I can kind of understand that.
There's 2 ways of really looking into an economy. You can look at some of the data, the official data, or you can try and do it via the companies that operate there. You can gauge China through your Australia business and the China business. And in the data this morning, Germany tells me China's not pretty. In your numbers, it tells me China's great.
Yeah, and look, I think you have to be slightly cautious on that. We've discussed before, you know, we're the second largest white-collar recruitment business in China. We've got 150 consultants. So I've got 2,500 consultants in the UK. So there's still a lot of structural growth opportunity. We only work in the white-collar professional space, and for us, we've just had an all-time record in the last quarter. And, for example, October looks good. So I don't think we will necessarily see much of an impact across Asia. But we're growing at 11% in Asia. If Asia was really fast forward, if it was strong growth, I'd expect our growth to be closer to 20%. The key for me is across Europe we're still growing very strongly because, of course, places like Germany, we're by far the largest recruitment business in Germany in the white-collar space. We've got 1,100 people in our business. Our growth has just accelerated from 6% up to 10%. I'm confident to accelerate further in the next quarter. So all the signs are still positive. But does that mean that, back to my point, I think more businesses are going to be a little bit more focused on how much capex they spend, how much revenue spend. That's different from cutting. I've seen no signs so far of any cutting in investment, any cutting in headcount. We've seen a little bit more cautious focus on cost control, but for us, there's still a lot of opportunities.
Richard, Paul's world, he paints a lovely picture, doesn't he, of what's happening in Europe. The guys at the Bank of England, they don't paint a lovely picture of what's happening in Europe. The guys who expect rates to rise in the back half of 2016, they also don't paint a lovely picture of what's happening in Europe. Whose story is right here, if you can say one story is right and the other story is wrong? Do we have to re-engage with when rates are actually going to rise?
Well, I think if you look at what investors are saying about both the Fed and the Bank of England, there is some concern that the macroeconomic picture is a little bit more cloudy than it was. And the payrolls number in the U.S. on Friday was a uniformly bad number. And you look at it and there's not a lot of, you can always sort of pick out something positive from a non-farm, disappointing non-farms report, but there was nothing there to really give any optimism. Now, it might be a one-off, but I think there is a fear that this is the beginning of something that is starting to take hold, that maybe we've peaked and maybe we're on a sort of a downward trajectory on the macro view of not only the US but of the world. And I think investors are a little bit concerned about that.
Market expectations much more dovish than the expectations at the Bank of England. That really is the question, though.
Yeah, and I think, you know, I think markets are looking at what looks like a delayed Fed liftoff now impacting on the Bank of England, and that the Bank of England will not go first according to what investors are thinking right now.
Paul, very quick, final question. We're talking about markets, we're talking about investors, you're talking about businesses.
Yep.
Do you care about a 25 basis point rate hike? Does it change anything in your world at all?
No, look, it's going to happen at some point in time. Whether it happens in 3 months, 6 months, 9 months, the key is that any increase is very modest and very gradual. You know, what we don't want to see happen is a 1/4 percentage point increase in 3 consecutive months. Absolutely, that would impact the economy part of it. Most businesses are expecting it. Remember, most businesses have got a lot less debt, including our own. We have a lot less debt on our balance sheet, almost 200 million lower than we had 2 or 3 years ago. So I think the impact of interest rates is a little bit less. Again, I think this is more about, we've had a very strong run for a couple of years, and companies are just beginning to see their order book. There's not the same growth as there was a year ago, but there's still growth. And this may just be, we have a period of time, as we've had so far, fairly slow global economic growth in comparison to the boom sort of periods we've had in previous up cycles. For us, I take the economic conditions we've got today across the world and we're very confident we can grow our business. What we are looking for is an absence of a major shock. And so far, we still haven't had a major shock. Clearly, what we've seen in China, things like VW is quite important in the German psyche. Those have the potential to be a shock for the global economy. So far, no signs of that yet. But we'll talk again in 3 months' time.
Do you think it will?
I'd see no signs of that currently. I think, look, well-run businesses, they read the newspapers, there's a good chatter between various companies what they're seeing, and I think a lot of companies at the moment are saying, right, why would I put my neck on the block and accelerate my investment at this point in time? A lot of companies have made a lot of capex investment, a lot of headcount investment over the last 12 to 18 months. Why would you accelerate that at the moment? You know what, I'll be cautious for 2 to 3 months. And for us, as we discussed before, any little bit of cautious means our growth slows down. I think for the UK, that's just a cautious across September has reduced our growth to 6%. In Europe, we said before, we can have much less economic growth, just some broad stability, anything more than 1% GDP, and for us, because of structural growth opportunity, it's an attractive market.
Paul Venables, always fascinating, Finance Director at Hayes, and Richard Jones, of course, of Bloomberg First Word. Thank you very much.